Okay, just as a few more people are joining, and we'll kind of kick off on the introduction side and get us warmed up. Thank you for everyone who has registered and joined us today. If you're watching it live or if you're kind of watching us back later, a very warm welcome, and a warm welcome to our esteemed panel of guests as well, who are going to be sharing their views and insights on the kind of current trends within the mortgage market and what we're seeing and experiencing out there in the wide world at the moment. I'm delighted today to be joined by Tony Wells, who's the Head of Competence and Evaluation, Home Buying and Ownership at NatWest Group, Andrew Montlake, Managing Director for Corico, Craig Skelton, Managing Director for CS Financial Group and CS Mortgage Solutions, and Stuart Mosley, who's Managing Director at SJ Financial Solutions. A huge welcome to you all, and thank you so much for kind of giving up your time and expertise to kind of to present and talk to us today. So for those of us, for those of you not familiar with Recordshaw, my name is Stephen Hewlett-Light. As well as being your host for this event, I'm also the Head of Product Delivery and Marketing for Recordshaw. We're a RegTech firm helping financial services businesses to better record, store, and analyze their customer interactions using AI, machine learning, for the purposes of monitoring compliance and conduct. And we do that across a range of businesses and sectors, mortgages being a key one for us. And we'd be delighted to kind of talk to you, any of you afterwards, should you want to know more. Many of you have joined us today will have downloaded the research paper that we recently published on the state of the mortgage market and some of those factors that are impacting people buying and selling their homes in both the UK and Australia. And if you haven't taken a look at that report, please do go take a look. You can find the link on our LinkedIn page and on recordshaw.com as well. We're going to pose some questions to our panel today. So this is going to be a panel discussion rather than a series of presentations. We have some questions prepared for them, and you're more than welcome to post in questions as we go through the session as well. And I'll try and pick a selection of those towards the end of the session today. Before we dive into some of those questions, which are going to be based around the research paper that we published, and of course some of those ever emerging trends in the mortgage market. I just thought I'd pull out a couple of key points from that research paper that I certainly found really interesting as we were doing that research, and that I thought kind of would set the tone and set the scene. So the mortgage market, it's undoubtedly been incredibly healthy since the 2009 financial crisis. I mean, there's been over the last decade, that gross mortgage lending position has doubled to around 268 billion in the UK, which is an impressive feat. But if you look at the last 5 months, in the first 5 months of the pandemic, we were seeing around 1.9 million mortgage accounts being subject to emergency payment holidays, and clearly the world turned on its head in the middle of last year. You all know that by now. But certainly there was an immediacy of drop off as people weren't able to go and see mortgage advisors, for example, and also as people didn't necessarily feel like moving home in the early stages of the pandemic. But despite this, after lockdown 1, after that was lifted, and none of us could have predicted back then that it was going to be a trilogy, but after lockdown 1 was lifted, mortgage approval shot up to 66,300 in July, which was more than 7 times higher than in May. So the whole sector, the whole industry went through this kind of real boom through the summer as a few factors came into play, really. Some of that being stamp duty relief, which drove many to kind of push for a move. Suddenly everybody was spending a lot of time at home and reevaluating what that space was for and what they needed their space to be going forward. And also what was fascinating and interesting throughout the whole of last year is buying a home itself changed for many, with everything from virtual viewings, a lot more dependency on telephone and Zoom-based mortgage applications really became the norm, and it really changed the way that a lot of the sector would do business, and could could well have ramifications beyond the lifting of lockdown, which we're all hoping for later this year. So a lot of things going on in the last 12 months that are worth kind of taking stock on and reflecting on. It would be remiss of me not to mention some of the announcements in the Chancellor's budget yesterday as well, and how that might affect and impact things. And we'll maybe try and temper some of our answers with the panel around some of the kind of predictions for the future. But of course, the extension of furlough schemes and restart grants for some will be positives. And of course, with every budget, there are always things to consider when it comes to how that will be recouped in tax and so on. So a lot of people looking at the budget announcements yesterday and thinking, what will that mean for the economy, but also what will it mean for home buying going forward as well. Many of those support schemes that are kind of being extended do have to end, and quite where that will leave things from an economy and mortgage market perspective, we will certainly try and touch on and discuss a little bit today. But yeah, it will very much be a different world going into 2022, hopefully, than the one we've seen in 2020 and 2021. Well, enough from me. We've got a few more people who've joined us and attended as we've gone through that, so that's fantastic. Thankfully, it won't be too much more of me talking. It'll be mostly our esteemed panel. So let's pose some questions and get us started. I'm going to ask to kick us off. I'm going to ask you all the same question, guys. So. And I'll start, come to you first, Tony, and then Craig, and then Andrew, and then Stuart, if that's okay. The first question from me is, what do you think will be the main drivers impacting the mortgage sector over the next 12 months? And Tony, if we can come to you first, please.
Thanks, Stephen. It's good to start with me. I think because I work in a support function within the NatWest Group, and so don't profess to be an expert. So I'm learning as much from my colleagues here on the panel as others. But so I think what I'll do is lay the foundations which they can build on, and maybe start on an optimistic note. I think obviously the drivers in the next 12 months will be external economic factors and possibly even political factors, primarily around things like the pandemic, Brexit, etc. As you referenced the budget only yesterday, and seeing some some optimistic support there for the industry. So personally, as I go into 2021 with a sense of hope and optimism, generally speaking, but also a really good dose of care, making sure that we continue to live in quite different and difficult times for our customers and our staff. So we go into that hopeful period being very careful to keep both our customers and our staff safe. So that's sort of the foundation for my colleagues here on the panel to build on, I guess.
Great, Craig. Can we come to you next?
Absolutely. Same question. Yes. No, thanks, Stephen. I think mine is obviously more from a mortgage broker sort of viewpoint with it. Really, I think the main drivers and the will be more about the affordability. So assessing affordability. We're going to talk about the budget yesterday and things like that. But 95% lending is great. I think one of the key drivers is always going to be about the lenders assessing affordability, how they're going to assess that. With the furlough scheme being sort of extended, self-employed grants, they're all influences that lenders take into account with regards to affordability. So that's a big thing for me. Keenness to lend as well from the lender's point of view. Processing timescales as well, just with regards to not only the lenders but also the conveyancing side of things as well, so the solicitors. So I see those being the sort of key drivers, and also as well the good news with regard to the easing of lockdown, so the developers and the builders can get back onto the sites in a little bit more sort of in a quicker way really, and get those the buildings completed and get those sort of chains completed as well, with a lot of chains being held up with the new build. So yes, that's my views.
Thank you, Craig. Andrew, anything you'd expand on there?
Yeah, I mean, I'd agree with that. Obviously, from a mortgage broker side of things, it's been a strange old time, hasn't it, for everyone? So look, we are where we are, and for me, at the moment, it's all about vaccine, and how we come out of that shapes a lot of things. It shapes how quickly we can we can all get back into some semblance of normality, even though the world has effectively changed. I think I'd agree there are a lot of positives. One of the big positives is the amount of savings. People have saved a lot of money. I know there's also been a lot of people sadly affected by all of this, but there's also an awful lot more people who have been able to save over the last 12 months. And it's interesting seeing the housing data over the past month or so, that we've seen house prices actually rise again. If you saw the nationwide house price index, and that was on the assumption that stamp duty would probably end in March. Now we've got an extension. That basically shows me that actually the demand for property is not just about the stamp duty. So add in the fact that you've got stamp duty extension, add in the fact you've got the 95% mortgage guarantee, and add in the fact the normal reasons why people want to move are still there, plus the new COVID related reasons that now people don't have to commute into a central office 5 days a week. So they're looking at moving out, getting more space. They need outside space. They need a home office. That's the new thing that everyone wants. So actually, I think demand for property is going to be quite strong, no matter what, going through this. The unemployment figures aren't quite as bad as people feared, which is great. The vaccines are being delivered at greater speed than people thought, so that is great. So if you think we're going to have a 4% or so recovery this year in GDP, 7% next year, I think it's looking pretty good. It's about how lenders adapt. It's about affordability and criteria. Absolutely, Craig's spot on with that. And it's about how we all adapt to the new breed of consumers out there and the customer journey they're going to want going forward.
Yeah, we'll touch on a couple of those things in some of the later questions as well. The kind of rise in house prices is an interesting one, isn't it? It certainly kind of took a few people by surprise, I think, but in hindsight probably shouldn't have done. Stuart, I'll come to you next. Same question. Everybody's been really optimistic so far. Hopefully you're gonna make it 4 for 4. I should hang out with you guys more often. So I'm feeling better about the world already. But Stuart, same question. What are those main drivers impacting the mortgage sector in the next 12 months?
Well, I suppose on the positives, yes, I think the 95% is great moving forward. There's a lot of first-time buyers that are suddenly getting excited. Our office phones have been ringing saying, "Oh, when are they available? What are the rates? When can we do it? Can we see you Saturday?" etc., which is fantastic. But I think from a lender's perspective, I think various lenders, and as a broker, many brokers will have the same, where we can submit a 90% loan to value application and we get an offer in 2 days. We can submit an application at 60% loan to value and we get an offer in 3 weeks. And the 60% same lender is a far better candidate than the 90%. And I think lenders just need to look at their processing, because if they're going to have an increase in inquiries at higher risk, higher loan to value lending, they need to be looking at their processing. And I think much of it is probably going to be they've got underwriters scattered all over. They're not in a big call center now where they can turn around and ask one of their colleagues, "What do you think about this?" They're working from home. To try and get a response and an answer about a particular case is taking slightly longer. And I think another impact is probably going to be the volume of applications that are probably going to want to go through and complete before the end of June, and certainly by October, is going to mean a knock-on effect, not just on the underwriting, but on the legal process. Local authorities, local searches taking far longer. And unfortunately, it's usually, well, from experience, it's the broker gets it in the neck when it doesn't quite go to plan, but actually it could be a local authority that's taking 4 weeks to get searches done. So I think, yeah, mortgage side important, but I think there's all the other knock-on effects from surveyors, specialist reports, and the legal side that really needs to be aware that we could see a huge impact, an influx of inquiries once 95% deals are released from lenders.
It's an interesting counterpoint, isn't it? Where the industry may end up focusing on one particular aspect, and that ends up slowing other things down. And I hadn't really thought about that knock-on effect to some of the people who are obviously working remotely and probably would more value that kind of that ability to check with their colleagues, and underwriters being a good example. So it's a really good point.
I think I can remember sort of middle of last year, there were certain big lenders where if you instructed the surveyor, it was going to be about 5 or 6 weeks before they could gain access. And of course, we're not going to get a mortgage offer till that survey is done. So the whole thing is delayed. And if we get that situation again now, it could be quite a slow spring, summer.
Interesting. And you did well to do your weatherman routine there with the spring summer. I could feel the map behind you. It's amazing. Thank you, Stuart. And look, so that actually ties us nicely off to the next question, which is around which I'm going to come to you on, Tony, if I may. What are the main difficulties advisors and supervisors face with remote working? We just heard some of the things from Stuart around concerns around some of the other parts of the value chain in the mortgage sector. But what about advisors and supervisors themselves and how they've been finding the world?
Yeah, I think this is primarily around advisors and supervisors. I think it applies equally to other roles that work from home. I think, having read your paper, you've summed it up reasonably well in the paper, to be fair. There were and still are some difficulties, but there's also been some positive sides to remote working too. And I think I would probably split both of those into sort of 3 main areas. That initial transition to working from home, then the ongoing logistics of doing business, undertaking your role from your home location, and then the practicality of being at home. That transitional period, the practicalities of moving out of an office, a call center, your branch, to a home environment was mainly one for employers, I think, to organise. Although it did create a huge amount of effort and cooperation from the advisors and supervisors. There's things like organising phone lines, technology, even to simple things like desks and chairs was no mean feat logistically and happened relatively quickly. Then there's that logistics, the practicality of doing appointments, packaging, etc. for advisors, and then that transition to remote supervision for supervisors was also a factor. And then, certainly probably one of the primary ones still, hopefully ending very shortly, is sharing space with partners who may also be working from home, particularly those with young children, adding to the challenge. I can't imagine trying to provide advice to customers and homeschool at the same time. But I think the experience for advisor and supervisor in each of those will be very different, and very much based on their personal circumstances. But broadly, I think the more flexible the approach to working prior to the pandemic, the lower the impact of moving to home working during the pandemic would be. So those that were used to flexible working previously have transitioned to it very smoothly. Just obviously at home more often. The simpler the processes for customer advisors, the easier it's been to adopt doing business from that location. So, for example, less reliance on paper or paperless processes made it much easier. Digital tools in the appointments made that process again easier for both customers and the advisors. And I think one thing that was a concern to the start, and actually I think turned into a positive, is that customers were in the same boat too. They too were working from home. They too were schooling their children, and so that became some form of icebreaker almost. That meant we're all in this boat together and can move forward on it. And those things were almost very applicable to advisors and supervisors, but also, to Stuart's point, applicable to those behind the scenes that were servicing too. And I do hope that the benefits of flexibility, the use of technology, new ways of working, new ways of collaborating, etc., will continue to feature in some shape or form going forward when we've got this pandemic behind us. Because it does, that word flexibility can work in our favour, moving people in and out of different areas to support where there is demand requires. So let's hope some of that stays with us as we put this behind us. Does that?
Yeah, it does. Thank you, Tony. It's been an interesting and wild ride, and you struck on the point probably most dear to my heart, and I guess quite a few people as well, that the 8th of March is not that far away now, and it cannot come soon enough. I love my daughter dearly, but homeschooling whilst working has been a challenge. Very good. Thank you, Tony. And so, Craig, if I come to you next, actually, so you know, there was a prediction of a kind of decline in mortgage demand in 2021, to the extent that the budget may have influenced some of your predictions and thinking here. But do you think that will be the case? Do you think we'll see that drop off this year in mortgage demand, or do you think things will sort of continue?
I think certainly the announcements yesterday will have a positive impact on the market. I think I'm kind of trying to think now of how I can bring things down, because you sort of said we're so positive panel so far. So I think I'm trying to be how I can find sort of negative points to come out with. But I'll try and be as positive and as I can. But I think no, I don't think there will be a sort of downturn for demand. I think the stamp duty extension, will that help? Absolutely. I don't think it's a deal breaker. I agree with Andrew's comments on that. I don't think that was the be all and end all as what people thought it was going to be. There's sort of the good news, obviously now there's no cliff edge with that, and the solicitors can sort of breathe a little bit sigh of sort of the timescales that they're now working to compared to the end of March. I think and also the good news as well from being based in the north, that sort of the stamp duty threshold up to 500,000 running till September is also a very big positive thing for us as well. So I don't think there's going to be a downturn from that point of view. But I don't think that the stamp duty has been such an influence. I think when we sort of look at our pipeline as a firm, we preparing our customers for the worst and taking the stamp duty as a bonus, shall we say, rather than the sort of a necessity. So we were always in that sort of frame of mind with regards to the stamp duty. 95% lending, why is that? That's always going to be a positive influence on the market. As Stuart sort of already said, we've sort of had quite a lot of impact already in terms of the calls, what people want in appointments. The good thing is as well, we've also got sort of people have been approaching us as a mortgage brokers for the last year in terms of the ones that couldn't get 90% mortgages because the criteria, 95%, those clients have saved a little bit more. But we are going back to those clients as well and trying to sort of spark their interest again in terms of looking at that, because obviously the 95% will have a positive influence on those people as well. With regards to that, I think the good thing about the 95% is, and why that's such a positive thing, is that it's just not geared to first-time buyers. A lot of incentives is always geared towards first-time buyers to get people on the property ladder. I think the big thing is now that it's not just open to those people, it's open to the home movers as well. There's no, unless my sort of esteemed panel can sort of correct me, there's no sort of confirmed exact date yet from some of the lenders. HSBC have come out and said the 19th of April is when they're geared up for it, which is great. So at least we've got a date with that. I know Virgin Money are looking at May. I've not seen anything from Lloyds, Barclays or Santander as yet. But I think the point with all this goes back to affordability. I think that is the biggest sort of challenge with regards to the whole demand for mortgages right now, because there's still going to be people that are still not eligible for 95%, even though they were keen to get on that property ladder. There's still going to be, because the criteria, because we've only got 4 lenders at this moment in time that are looking to do that, then not every single customer, even love to think so, not every single client of ours and the mortgage broker world will fit within the criteria of HSBC, Lloyds, Barclays or Santander. So even like I say, it is about affordability. That's the big thing. That's going to be the biggest challenge as well. So I'm trying to throw a bit of negative in there, and so if that's coming across, Steve, I'm trying to get you a bit of balance in that. Great news, the furloughs extended, absolutely. Self-employed grants, more people, 600,000 people more eligible for those now, which is great. But the mortgage payment holidays as well that was introduced are all real positive things. However, that has an impact on affordability. So lenders don't like furlough, some do, a lot don't. Self-employed grants don't like it, some are okay with it. So I know we'll talk further about this, but I think the need for mortgage advice will be even more key, and as the mortgage demand goes up, I think the need for advice will increase as well massively. I think processing timescales are better. So when we talked before about the lenders geared up for this, and when Stuart referred to certain lenders earlier, we all knew who those were, which was a positive thing. But again, I think that the biggest challenge is going to be for the lenders geared up for the processing timescales. Like I said, they are far better than we were 9 months ago. People are more geared for home working. Absolutely, they are from an every angle point of view, but more importantly from a lender's point of view and the solicitor's point of view. But there's still issues, and that's going to that will continue. But I think that the key to it is affordability and making sure the processes are right from a lender's point of view. We're also finding that demand, particularly sort of in terms of we do lifetime mortgages, so equity release, which are sort of vulnerable, can be vulnerable for certain clients, but we've sort of seen an increase in demand for lifetime mortgages, so people looking to help the bank of mum and dad and bank of grandparents as well. I think that it's, the 10th biggest lender in the UK right now is Bank of Mum and Dad. So absolutely, that is also again going to help with the increase in mortgage demand. House prices, which you touched on before, I think if you'd spoken to me sort of a few months ago, I'd have said probably a slight decrease in house prices towards the end of the year. I don't see that now in terms of probably 2020, 2022. Yeah, I think there will be a sort of slight sort of decrease in house prices, but I don't see any change with those as we progress through 2021 with all the positive stuff that's in the market.
Yeah, thank you, Craig. There's a lot of in there, Tom Pitt. We're going to touch a little bit on some of the vulnerability points you made earlier on, and you know, you and Stuart are clearly wonderfully aligned on the process challenges around the market. And again, I'm not looking for the negatives in this. If you guys are optimistic and happy about life, that's a good thing as far as I'm concerned. And I say, but don't let my natural pessimism drag you all down. Take a slightly different angle. See if there's some other implications on the mortgage market coming in this year. We've heard a lot about COVID and remote working and those kinds of things, but there's still room in the world to have a conversation about Brexit. We're not going to ask anybody how they voted ever, but Andrew, I come to you, please. What do you think the Brexit ramifications could be on the mortgage sector this year? Let's test this positivity vibe and see where we go.
Positivity, Brexit. Interesting one, that. So without depressing everyone too much, look, it's all done, isn't it? It was all really easy. There was an out of the packet deal, and we're all happy and marching on with our blue passports. It's not that simple. And what is really, really interesting, this is where it affects the mortgage industry, is that actually the trade deal has been done, but the financial services trade deal hasn't. And that's what a lot of people forget. So actually, if anyone wants to know how this affects the industry, then a bit of publicity. The Association of Mortgage Intermediaries fact sheet on Brexit is fantastic. It's the most detailed thing that I've seen. So if you're not a member of AMI, become one, and you can find some great information there. But it's really going to affect us in a couple of ways, and it's affecting us now for all those brokers who deal with people who are overseas, who deal with people who might be expats living in France or Germany or Spain. And that's one of the issues, because what we've lost is our passporting rights, which gives us the ability to deal with these people who are living overseas. So there is an alternative to passporting rights, which is something called equivalence. And we've got equivalents in a number of areas which we can use, but unfortunately it doesn't include UK financial services firms. So the risk is that if you're dealing with people in other countries, they've got different rules and regulations now on areas such as cross-border communications, servicing of a customer, and we can fall foul of that. So it's important that firms with customers in the EEA understand the local laws and regulations in each of the relevant jurisdictions. So it's a massive grey area at the moment, and I know there's a bit of a deadline being put on. Hopefully we'll get this sorted out by the end of March. That's the time scale that's been been ticked. But as with anything to do with Brexit, we don't know if that's going to happen. If you look at the spats that are going on around the COVID vaccines at the moment, who knows what's going to happen? So it's a massive grey area. It's really interesting what Boris and co are going to do, because they're going to be desperate to make sure that we go through this and they prove that Brexit was the right decision and that it's really going to work for the UK, whether that's with the free ports or turning the UK into some kind of Singapore on sea type community. So there's a lot of unknowns, really. A lot of people think that some of the regulation is suddenly going to disappear. It ain't. We're not going to get rid of ESIS, for example, and go back to the KFIs that it was before, because why would the lenders spend loads of money in doing that? A lot of the laws are enshrined in UK law now, so it's not just going to suddenly change overnight. So there are lots of unknowns where financial services is concerned. And there are as many negatives as there are positives as well. As with anything in life, we can approach it and say, look, this is an opportunity. And that's whichever way you voted, it's probably no secret which way I voted, but whichever way you voted, it's done now. And we have to make the best of this opportunity for everyone and prove that actually, agree with the decision or not, we have to make it the right decision. So there are lots of different things that could happen. There are lots of positives, but hopefully the grey areas will be sorted out sooner rather than later, because everyone hates uncertainty.
Yeah, so often said uncertainty is the devil's work for a good market, isn't it? But yeah, so thank you for that, Andrew, and definitely some good resources to go and check out there. So for those that scribbled that down, do go and check those out. Stuart, going to come to you next. Actually, explore another kind of angle, I guess, on or consideration as we look at 2021 and beyond. But you know, there's been an ever increasing focus, for all very good reasons, on kind of customer vulnerability and making sure that we're treating customers in the best possible way for their circumstances. And how do you think, I guess, lenders and advisors continue to deliver appropriate and compliant, but also compassionate advice, given that, you know, there are still there are lots of positives that we've heard about, but there are also some difficult people in difficult circumstances at the moment with the way things have gone since COVID. So how do advisors kind of keep that going and make sure they're doing the right thing?
I think, I mean, very basically, it's listening to the clients and their issues and their concerns. And I think going back a number of years when banks and particularly brokers had their targets on the walls in their office and the bonuses being rewarded, etc., etc. I think what you tended to find is if a client were to ring with an issue, a situation, or a concern, it was, well, this isn't a deal, off the phone. And I think certain lenders, having spoken to clients in the last sort of 6-9 months, still have that sort of ethos that if somebody's ringing with a bit of an issue, oh, can't really help you, sorry. And I think listening to the client and also just a bit of out of the box thinking, a bit of common sense. I think that sometimes you can have a client ring with a query or a situation that you want to try and advise them. And just by thinking about things differently, you can suddenly come up with a solution for it. You know, we had a client rang probably September-ish last year, and they needed some advice. We told them how to speak to the lender. They came back to give us the feedback, and the lender had just gone against what we'd suggested. And in the end, we had to involve our BDM for the lender to speak to the powers that be at his employer, i.e. the bank, to come back with a solution. And I think if the person on the phone had just actually thought about the conversation that we're having with the client and the longer term impact of them not helping their client out, and they weren't asking for the impossible, they weren't asking for something, you know, money for nothing or anything. It was just a simple way of going, hang on a minute, if we offer this, the long-term benefit to the client is this, financially they're better off. You know, there are many vulnerable customers out there, and that could be from financial reasons or, you know, health implications or mental health issues. But they all need listening to. They all need somebody on the end of the phone who can go, yes, we understand, situations arise. And having spoken to various clients who've spoken to the various lenders regarding anything as simple as a payment holiday to, further financial issues, we tend to find in certain instances, the smaller lender, the less corporate-y on the end of the phone can be a bit more empathetic with that individual, and they can go through a situation where they can explain the situation. The person on the phone will say, "I'll call you back," and they do call back, and they come up with a solution, and it's sorted. Only today, this morning, I spoke to a client who'd had an issue with a huge lender, and it has taken 3.5 months to sort something out that probably could have been sorted out in 10 minutes. So it's taken unnecessary stress to a client, an awful lot of time with that lender, and the lender has given the client £190 for their income, their hardship. And you think that could have all been resolved, made everything a lot quicker and easier if somebody had just thought about it and just come out with some different ideas, thoughts and solutions.
Yeah, I mean, it's that importance, isn't it? You touched on it right at the beginning, and that listening to the customer and then trying to find the best outcome for them, where there doesn't necessarily fit in the neat box that the products are often designed to fit into. That's really interesting. Thank you, Stuart. Tony, I'll come to you next. I guess there's lots of different implications, both positive and otherwise, in terms of the mortgage market, and I guess. In what you're seeing or what you're planning for, do you think there's going to be a spike in remediation projects, or in kind of are we heading for any kind of mis-selling scandals or at risk of them in the mortgage domain at the moment, or are we kind of not heading for that sort of world?
So it's a good question, and I sort of understand why you've asked it, but I think the answer to that one is in everybody's hands that's involved in that client chain. The thought experiment goes something along the lines of, if we think the answer is yes, then we should ask ourselves why, act on it now, and then the answer becomes no. So for me, I mean, it sounds a bit glib, and it's not as simple as that, but for me, it's similar to what Stuart was saying. Think about staying close to our interactions, thinking about our monitoring, our follow-up as we change and adapt, starting at all levels, whether it be advisor, supervision, and then up through the system, QA, controls, audit, whatever, and wherever we are on the chain. Support the customers, do what's right for the customers, if a mistake is made, which they do from time to time, fix them. So I hope that doesn't come across as a sort of a politician's answer where I haven't really answered you, but remediation is generally looking back, and we're in it now, aren't we? So acting now feels like where the focus should be. Do what's right now, avoid problems for them and therefore us in the future. Does that make sense?
Completely, and you knew I was always going to throw you a thorny one in there somewhere. Yeah. But thank you for kind of clarifying. And I think there's a lot in your answer there around focus on now and make sure that you're doing the best possible thing by your customers, and
focusing on now, being cognizant of all the change around us, and following up on that appropriately wherever we are in that chain. Yeah,
perfect. Thank you, Tony. So I guess when things kind of do go wrong, you touched on even mistakes. Mistakes do get made. People are human. We're all human at the end of the day. I guess there's always that risk of kind of reputational damage of making that mistake. And Craig, I'm going to throw you an unfair question now, if I may. That is in your opinion, could reputational damage have just as much impact on a firm as, say, kind of having to put something right for a customer financially, or kind of risking any of the fines that unfortunately do come along with being a regulated business?
To be honest with you, Stephen, I think the damage to the reputation would be bigger than the fines. I think, as we all do, as for me, trust is a massive thing within the firm, within the advice, within the advisors that give that advice, and sort of trust is just such a huge thing. And a fine is just a short term. Obviously, it can be so have a major impact in terms of the sort of the bottom line. But generally speaking, I would say that something like that would be reputation would have far more short-term and long-term damages to the business, without a doubt. I think so. I'm speaking for myself, and I'm sure Stuart and Andrew feel the same in terms of we've spent time building our brand, building sort of our sort of client base, and building that trust up with our clients, when we are, not through anybody's particular fault, but we are, whether we like it or not, and I'm going to throw some negativity in here, that it does sadden me sometimes that we are quite an untrusted industry. Generally speaking, we're untrusted. And that's not down to anything particularly today. I think that's just down to the long-term sort of stigmata with regards to financial advice, mortgage advice. So I know the other guests have touched on it in terms of things, the wall boards and all those sorts of things, and that pre-RDR, they would say things like endowments and things like that. I know quite a few of my friends and their viewpoints before I went into this world was very much about it, sort of financial advisors are in it for themselves. I'm not saying that everybody's like that, absolutely not. It's just a general thing around that, and that's really, like I say, it does sadden me that we are and we'd spend a lot of time trying to sort of build the reputation, which can be lost quite quickly, just through through the sort of the remediation that sort of needs to be done. So it is more of a long-term thing. I think the thing with regards to your brand, people never forget. I think the thing is, like, people, as always, don't sort of seem to forget the good stuff that you do, and 2 years later when you're ringing them up about the remortgage 5 years or anything like that, it's like, or if you haven't been in touch with them for a while, it's like people do forget, and mortgage advisors particularly sort of seem to forget, actually, if we're not in contact with that client, then we will lose that client through somewhere in the process. So I think people just do quickly forget how good you were the first time around. But then it's sort of, like you said, with regards to the whole sort of trust within the business and the long-term damage, if you've got then the bad reputation, brand's everything. You don't want the wrong brand awareness. That is the last thing you need. Now with online presence, Google reviews, all those sorts of things, trust and the displaying of trust is a massive thing for the customers. I'm speaking about my own firm and the advisors within the firm. We rely a lot on Trustpilot. We use Trustpilot as the review platform that we use, and the feedback from our clients is vital. We're very open and honest. We send most clients get the review invite to do that, and I think that's, I would be, the advisors in the firm know if we've had one sort of not so favourable review, should we say, and that's over the last 4 years, and that was just down to misunderstanding regarding roles and responsibilities. So I think, and that I know how I felt about the firm's reputation just by getting a 2-star review over the last 4 years. So things like, you're looking at more serious stuff, it is heart-wrenching to think that could sort of damage all the hard work that the likes of myself, the advisors, the likes of Stuart and Andrew have taken the time to build their brands up, really. So in answer to your question, the short answer is far bigger than the fines. I think firms can deal with the fines and move on. What they struggle to deal with will be brand reputation, and the damage to that is short-term and long-term.
Yeah, you used a word that that resonated with me hugely, which is around trust, and trust is hard to win and earn, and very easy to lose, and that's a slightly overused adage in our industry, but it's very, very true, and you guys work incredibly hard to make sure you get those you get the trust of your customers and clients. So thank you, Craig.
No problem.
And Andrew, I'm gonna cut to you now. So I guess we have had some fairly challenging times. It's fair to say they still are in many ways for many people, no matter how much we've got used to things, and often, I mean, Stuart was touching on some good examples actually earlier. Customers needing kind of even more specialist advice or extra help in certain circumstances. Do you think firms are able to kind of scale up that support quickly, and do you think that that's been easy to do, or is it difficult to do, and how's that been from your perspective?
I think it's interesting, and it's different types of support, really. I think if you look at this, the specialist advice that people need now, that's what brokers have always done. That's why we exist. We were born in the grey areas. We're born to service these clients and give them honest advice that they trust. And it's really refreshing to hear, Craig speak like that. I totally agree. I trust him. So it's brilliant. But I think this is what we always do. This is why the brokers and the broker community, this is where we operate. We operate in difficult times. We're here for our customers. We're working long hours. They can call us anytime, day or night. We're not like a banking institution that have started to do some really good work, actually. And I think actually all of us coming out of this have learnt that partnership and working together and working for the customer is absolutely everything. And I think it's really interesting to see how some of the lender brands have adapted through this period, and it will stand them in a lot better stead in the future as well. But for brokers, in terms of specialist advice and gearing up, we're not doing anything different. We're doing what we've always done. We have to be a bit more aware of vulnerability, and I know we've spoken about that briefly previously, and because there are a hell of a lot more people who are vulnerable at the moment. Mental health is something we have to bear in mind as well. We've all had our challenges. One of the biggest challenges of working from home is we're very social animals in the mortgage industry, and actually suddenly being cut off. And I know I've got my fancy background, but I'm literally working my Harry Potter-esque cupboard under the stairs office for hours on end. That's quite that's quite difficult to deal with after a year. So in terms of that, it's really about trying to understand the customer, what they're going through. And someone made the great point before, actually, that we are all in this together, and it is the perfect conversation starter with all our customers, isn't it? Is, oh, I'm sorry, my kids might burst in at any moment, and oh yes, I know what you mean. Mine's had a tantrum today, homeschooling. So it's all very interesting. But in terms of how we deal with our customers, do you know what? Brokers have always been doing this, and we're doing the same thing day in, day out. And long after this is over, we will continue to do the same thing day in, day out. And scaling up our support for people is something that we've always found quite easy to do when we need to, and we will continue to do that.
Yeah, it's really good insight. Thank you, Andrew. And the Harry Potter-esque cupboard comment earlier on made me smile. Thank you for that image. I'm desperate to find out what's behind the background now. But yeah, no, thank you for that. And it sounds like Craig, you've got a client in the making with Andrew as well, by the way. So I'm sure that wasn't lost on you. You'll be ringing him afterwards. I'm positive. Stuart, I come to you next, if I may. And really, I'm interested in. You shared with us as a group. Apologies for sharing with the wider group, but you shared with us as you were joining that you've been solidly back to back on Zoom calls all day by the sounds of it, and this was another one for you. I can sympathise, and I'm 100% certain that everybody listening can as well. But how has kind of technology and kind of that wider digitalization of the whole experience, not just the calls with the customers, but that whole end-to-end process around, the life of a broker through to the interaction with the lending firms. How is that technology having an impact on both the lending process itself, but also obviously the risks around lending?
Yeah, I think as I mentioned earlier to you guys, going back 12 months when suddenly we had to have the realization that we weren't going to see clients face to face. You know, we have an office, clients come to our office, we would see them workplace, home, etc., etc. Suddenly having that disappear, it was kind of, okay, what are we going to do? How are we going to get around this? Somebody suggested Zoom. Okay, see what Zoom's all about. And before I know it, I'm, you know, zoomed out. And initially it was a bit of a thought, well, this is not going to work because, you know, as a broker, we ask lots of personal information, be it on mortgage or protection. You know, it's not just how long have you worked for your employer, but it's your income, your expenditure, your waist size, etc. And to do that face to face is relatively simple and straightforward. Once you're an experienced broker, you know how to do it, you know how to approach the questions, you know how to react to, you know, the various answers that you're given over the years, and you can do it face to face quite easily. Suddenly having that taken away and having to do a meeting over the phone or via Zoom and WebEx and all these various different things we can do is very, very different. And initially it was a bit of a concern, but we are as busy now as we were pre-COVID. We probably have a little bit less time now, I would say, as a result, because as I mentioned to Craig earlier, we do appointments 45 minutes to an hour. So we'd still have an appointment now. But whereas previously we'd do an appointment and be able to generate various literature, regulatory papers, and so on, suddenly that's not an option. So we now then follow up the meeting we've had with copies of KFIs, ISIS, IDDs, all the regulatory bits and pieces. So you are kind of duplicating some of your time. So although it's not had an impact on business, it's probably had an impact on time and probably have less of it now. But on the plus side, the way lenders are reacting and their technology and their systems now are far better than before. And I think many brokers and banks have been, and building sites have been forced into getting off their backside, investing in technology and making these systems happen far quicker. I remember probably 18 months ago having conversations with, you know, various technology portals for sourcing, and they were planning this, they were planning that, and you'd go to another seminar and they were planning this and planning that, and it just never really kind of came to fruition. Suddenly it's there, it's happened, it's available. We can now upload documents. We don't need to fax them. We can now get documents from clients via PDFs on email or secure portals, send them to lenders. It's much, much slicker and simpler. And mentioning timescale earlier, where we get frustrated with the lenders on some of their timescales, I think some of the time is saved as a result of being able to upload onto a client's mortgage application their P60, their wage slips, their bank statements in no more than 5 minutes. And if the lender's got the systems and the people in place, then you can get that mortgage offer in a pretty simple period of time. And I think, you know, COVID, of course, is a, you know, horrendous situation that we're all in, and, you know, there's been many a sad story, but I think it has forced lenders and brokers to move their technology forward at a much quicker pace than perhaps they would have done previously. One thing I think we probably do find is clients need a bit more education on getting the documents to us, because, you know, probably like Andrew and Craig, we'll ask for the normal forms of ID, money laundering, bank statements, and so on. And quite regularly, we'll have a photo of a passport and somebody's fingers and toes are in it. You know, it's on the dining room table on a copy of yesterday's newspaper, and that's no good. And I think some clients need educating, say, yes, we do need copies of these. Yes, you can do it using technology digitally. You can upload it to our secure portal, but we don't need to know what the time on your watch stays. We don't need to know what slippers you've got on, because, you know, we've all had those photos where we've tried to explain to a client, we're not being difficult. We need them, and this is why we need them. So clients need the education on that side of thing. But, you know, as a broker, that's our job. That's what we advise them to do. You can download apps for smartphones, and I've yet to find a client who doesn't have a smartphone nowadays. So, you know, you can download a scanner onto your iPhone or your Android, pretty straightforward. I think certain lenders, if they've got a slightly out of the ordinary case, that bit of technology, I think, is still lacking. You know, we can all say, oh, we've had an inquiry recently, because as a broker, we've all had an inquiry recently that's ground to a halt due to some frustrating issue. But I think some lenders could just do things slightly better and embrace technologies as opposed to going slow. You know, very, very simply, we had a lender who insisted on writing for an income reference for a client recently. They work for Apple. They wanted to write to the main HQ in America for an income reference for a UK worker. How long was that going to take? Really? Now, the employee said, I've got an email address for HR. I've got a phone number for HR. It can be sorted. The lender, it's got to go via post only. And you just think, you know, clients can embrace it. Lenders can the majority of the time, but sometimes you just get to that slight hurdle, which you just think, come on, guys, this could be a simple problem resolved very simply without having to go round the Wrekin above the powers that be to try and get it resolved.
Yeah, it's amazing, isn't it? That we're in 2021, and you're still bumping into snail mail, and you said the infamous word fax, which anybody that knows me knows me that's like to set me off on a good day. I will refrain from doing that today, but yeah, I mean, look, it's amazing, isn't it? How that kind of technology, from the Zoom call all the way through to those accelerated roadmaps that you were talking about with the platform providers in particular, can really just change the way that you do business and really change things. But I think that customer behavior point was an interesting one, actually. Hadn't really thought about that before, of customer education, of how to get the right material to you, because before you just took it off them in the meeting room, right?
Yeah, I think the younger generation are typically okay with it. And, you know, you've just got to say, do you do online banking? Have you got the app? Yes. And very, very many banks now, you can get an app off your phone. From the app, you can get your bank statements. It does come out with a name and address on and an account number, so a lender can, you know, get the documents and put it against a file quite easily. But, you know, an older generation, and it's not even people who are actually much older, it's certain people who just haven't embraced technology. Suddenly they realise they've got to scan a bank statement that comes through the post. Well, they don't have a scanner. They can try and take a photo with their phone. Well, that's not acceptable. And as a broker, sometimes you can just feel you're putting hurdle after hurdle after hurdle in the way, and the clients get frustrated. Where, of course, in the old days, it would be, well, drop into the office, we'll photocopy it for you, it's done. So yeah, lenders are great, and they are moving forward. I think sometimes the consumer needs to just embrace the technology and, you know, understand why we need it, because it's not as being difficult. It's kind of what lenders require. And if you want to borrow £500,000, you know, they've got a right to ask the question.
Yeah, I think my favourite sentence in all of that, Stuart, was the reference to "in the old days," which was about 12 months ago. But absolutely, in the old days, we just used to take it off them in the room, which is really great. Thank you, Stuart. Really good. So we're going to come to kind of our last structured question, but I'm going to ask it to all of you, similarly to how we did at the beginning, where I kind of asked you for your views on sort of the main drivers impacting the market for the next 12 months. And you can feel free to be as optimistic here as you want, guys. So I'm not going to stifle your optimism. It was inspiring earlier on, but really the question is, what do you predict for the mortgage sector in 2021 and beyond, right? Say out to even as far out as 2025, which feels like a long time away these days, but what do you predict for the mortgage sector? What do you think is going to happen? What are your observations as time goes by? I'll start in a slightly different order. Let's mix the order up a little bit. Andrew, can I come to you first on that one? You can find the mute button. What do you predict for the sector going forward, and what do you think is going to happen?
Yeah, who'd have thought "you're on mute" would be the most used phrase ever. So what do I think? It's interesting, isn't it? So 2021, I think is going to be a similar year to the second half of last year. So I think, you know, we've spoken about all the things that are going on that are going to keep mortgages busy in our industry. I think what we've most got to learn is what I touched on before, is the power of partnership, the power of, you know, brokers and lenders really coming together and realizing that actually we need to work in partnership for the good of consumers and the clients in order to meet the demands of the new breed of clients, of what they're going to be asking and expecting and demanding in terms of the customer journey, in terms of customer service, in terms of using technology in the right way, and not using it in the wrong way to replace things like advice. I think trust that Craig spoke about earlier, that's going to be central to it. And going forward, I think we're in a really good position to learn from everything and take all the positives out of what we've been through. and that's going to be really, really key. I think advice going forward is going to be the central tenet of everything. I think customers need that advice more than ever, and I think they recognise that. I think there was a big kerfuffle made about the threat of, you know, the online mortgage brokers and that kind of stuff, in terms of, you know, going from A to Z without any advice or without any people at all. And while that's going to be there in the background, I don't think it's going to have the same impact that a lot of people thought it would do, because I think brokers are adapting. I think brokers are developing. So if you're a broker, it's about, you have to embrace technology. You have to get closer to your clients. You have to understand your client bank. You have to be in touch with them all the time and nurture them throughout the process, so that in 5 years' time, because a lot of people have taken 5-year fixes during this period, you're still front and central in them. So I'm optimistic about the future of the industry. I think there will be loads of different challenges in the future, but the one thing we do well as an industry is adapt. We always have, we always will. We might look slightly different to where we were, say, 10, 15 years ago. We might be slightly fewer in number, but we still adapt and we still go forward. And we have to have some uncomfortable conversations along the way, in terms of how we deal with diversity in our industry, how we get the new breed of advisors and the new blood into our industry. And they have to look like our clients, and they have to be representative of society. So women in finance, all power to that. Black Lives Matter, all power to that. We have to deal with this, and we have to have these hard conversations going further. And I think in 5 years' time, you'll see a much more representative, dynamic industry than perhaps we've got even now.
Amazing. Thank you, Andrew. There's some really, really powerful kind of good observations around that industry, and the optimism, you know, that you have and the rest of the panel has had so far around how that's going to work for the industry going forward. It's been fantastic. Thank you. Craig, I'll come to you next. I'm admiring everybody wondering who I'm coming to next. I should have done this throughout the whole thing. It would be a lot more fun for me. But Craig, if it comes to you next, what are your kind of your predictions for the mortgage sector this year and moving beyond?
Well, I'm quite disappointed, first of all, that we didn't quite replicate the Parish Council Zoom session that we've all seen on social media. So because I think we've been very much agreement with each other. And what Andrew said there's a lot of stolen my thunder in terms of my notes about what the mortgage market is going to look like 2021 and beyond that. I think there's the need for advice. Like the points Andrew's made is very, very clear. The need for advice will sort of continue. I believe there will be some sort of AI process within this process. However, there will still be the need for advice. So one thing that really frustrates me, and funny enough, I was talking to a lender about this the other day, is that to speed this, we can speed these processes up. So we're looking at not at 2021, but looking at the next sort of 5 years. The client will demand this process speed up without a shadow of a doubt. The data is, every single bit of data that we ask from the client is there in some sort of domain within sort of thing. And what my sort of talking with one of the lenders was about was really that I believe that clients should have a dashboard, shall we say, that when we sort of sit down with them, we already know what they spend on utilities. We already know what the car loan is. We already know what their income is, because this data is here. It's just not in one place. So we go to the client and sort of say, can you get me bank statements? That data's there. We could have that data in part of this process with the technology if we just embrace that sort of us all working together for the common good of the client. So I don't want to come across as sort of getting on my horse with something. I just think it's very archaic with the way that we sit down with a client and talk about how much to spend on this and how much is this and how much is that, when actually that data's there. We could sit with a client and know all that information even before we sat down with them and talk more about how we can help them as being brokers, because we are in this together. The client will need brokers. Brokers are here to stay. Andrew's right again with regards to a few years ago, online advice and things like that. Yes, they will have some place in the market, but fundamentally, this is brokers. This is what we do. It's sort of, we do piece things together, and we do offer that human touch, which is, but I think we could speed up the process a lot with regards to the data that we ask clients for, because Stuart's absolutely right. You would not believe the time that people take when you ask for 3 months bank statements, and then, well, you can have October's, January's, and February's. Like, well, no, we need the last 3. Well, why do you need that? Whereas the date, that's information is there, readily available. Like, from a client point of view, they can get those statements on an app, as Stuart said. So I think just helping with that to piece it all together to smooth the process. Conveyancing could be smooth, the process from that point of view, absolutely as well. There's a lot of things that can be done to smooth that process. So I think we'll find over the next 3, 4, 5 years that the process will actually become quicker, still within human interaction, absolutely, still within the need for advice. I think the other point as well is that the mortgage advice sort of community, it's not a dying breed, but there are less mortgage advisors out there than there was sort of 3, 4, 5 years ago. And I think Andrew talked about new blood. That is a massive thing for the industry as a whole, to move away from that sort of the lack of trust and getting that new blood in there. I know as a firm, we have quite a lot of our advisors that have never sold a mortgage before in their life when they join the firm, and fresh from a CMAP qualification. And those people are real talented and making a difference to the industry and sort of the client journey, really, because they don't come with the sort of the baggage of being doing this for years. So new blood is vital, speed of process is vital, and the need for advice is vital from my point of view. Sorry, I'm going on again.
Thank you, Craig. They're all amazing points, and I can tell you as a guy who loves technology, I think we're all clear that I work for a tech business. I'm going to love technology. I can tell you when we moved house, I still went and got some advice from a real person, and I love a robo platform, but I still wanted to talk to someone about what we were doing. So I couldn't agree more. Thank you, Craig. Tony, come to you next, if I may. What do you predict for 2021 and beyond?
Well, right at the top of the call, I struggled is the wrong word, but I sort of was guarded around predicting the next 12 months and bowed to these guys' better judgment as I'm not a strategist. So predicting the next 5 years and beyond, I'm in a similar boat. However, I do take some reassurance from what I've heard, because you'll never know. But what I was going to say was, I I predict new ways of working, new ways of interacting with customers and doing business with them, emphasis on interaction, using technology to help us. And we'll do that via product and technology innovation, but that helps customers, but not only at the front line, but also across the journey, which again, I heard. So I think, like I was at the start, I remain optimistic about the future and the part we all play in it as people, supported ably by new and innovative products and technology.
Thank you, Tony. And sound like I'm teeing up a technology play at the end of the webinar from the tech guy, but wasn't my intent. But I'll take it. Stuart, we'll come to you last, and I think you hold the baton for keeping it on a positive note, sir. Given where everyone else has been, but it's entirely up to you. We're in your hands. What do you predict for kind of 2021 and beyond, and how do you think things are shaping up?
I think as a broker, and yeah, I am positive with it, because I think it's a great market and great industry to be in. And I think the way COVID has sadly lost many people's employment, but it's gained many people's self-employment, going forward, it's a market where the broker looks at it and goes, we can help you with this. Because, as brokers, we see many clients who've been to the high street, they've applied for a mortgage with, XYZ lender, and just because they've not presented their accounts or their returns or their bank statements in the correct way to the advisor at the high street bank, and they've just gone, sorry, can't help you. As a broker, we can sit down and say, well, actually, let's use your salary and your net profit after tax. Let's use your dividends and your salary. That lender does this, and so on and so on. As a broker, we know how lenders, work. We know what calculations they're going to use. We understand what income they will and won't use, how they're going to calculate it, and how we can present it best to a lender. So I think as a broker, it's fantastic. I can only see our market becoming a bit more niche and specialist over the next few years, purely because limited company buy-to-lets are huge. You know, we're doing quite a number of limited company buy-to-lets, and, you know, high street lenders, not many of them doing the limited company buy-to-lets, and I'm pretty certain that many advisors in a high street lender would get in perhaps a bit of a tears if a client went in and started questioning them about limited company buy-to-lets over, you know, personal buy-to-lets, whereas a broker, that's what you're seeing them for. On the self-employed side, exactly the same. You know, we've got all the lenders we could need. You know, we've got all the tools, but it's actually the advice, the knowledge, the experience of that broker that is, you know, worth its weight in gold to a client. They can actually say, yes, we can get this for you. This is the route we're going to go down, and these are the reasons why. And there's nothing better from a client turning around at the end of it saying, well, I couldn't do that myself. No, you're right. That's why we're brokers, and that's why you see us. So I think, you know, yeah, they can go onto Money Supermarket. Yes, they can find the cheapest interest rate. You know, we only had a client a few weeks ago who came out with a rate, and they wanted this 2-year fix. And yeah, it was a great rate if they were buying in Northern Ireland. Unfortunately, they weren't. They were buying in Hampshire. That lender doesn't lend in Hampshire. Money Supermarket didn't tell them that. So, you know, it's invaluable advice you get from a broker, because we know the industry from the very small print of a lender to, you know, yes, that's the rate, that's the fees, that's the charges, and yes, we can help you.
It's amazing. No, thank you, Stuart. And look, I think one of the things, if I could sum up from what all you guys have been talking about throughout this call, is that there's an awful lot of optimism, and also a lot of strength in that mortgage industry. It's really really encouraging to hear a lot of that, actually, but it's also really encouraging to hear how you guys have been adapting and have adapted to some pretty dramatic changing circumstances over the last 12 months or so. The business has remained really good as a result, which is wonderful to hear. But also that you kind of you're looking at both kind of how do those efficiencies from you guys will be delighted to know I've run out of questions, which hopefully you can take some solace in that. But I just want to take an opportunity to say thank you so much for giving up your time, and for kind of giving us your insight, and giving us your views on what's been happening and what might happen going forward. If there are any questions from the attendees on the call, you can use the chat panel to kind of to drop a question in. Otherwise, I will start to wrap up and kind of maybe just give a couple of closing remarks. If any questions come in while I'm doing that, I'll make sure to ask them. The thing that I found really, really fascinating throughout that conversation was, as I say, just the optimism for the future, and I would love to come back, and if we did another report in 12-18 months time, get you back together as a group and say, oh, let's see how that bore out in terms of that optimism. But I think you're probably right, and certainly looking at some of the budget things from yesterday, you know, there's lots of support out there and lots of help out there for people to be able to hopefully continue to live their lives, and home buying is a massive part of that, as we know. We haven't got any further questions that have come in, so I'll kind of I'll try and wrap it up there. I say a massive thank you to everybody who has attended, anybody that's watching afterwards as well. Thank you for listening in. To our panel, Craig, Tony, Stuart, and Andrew, thank you so much again for giving up your time and for coming along. And we'll close the call there. People can drop off as they need to.
Thanks, Stephen. Thanks, everyone.
Thank you.
Thank you, guys.
Thanks, Phil.
Thank you.